Welcome to Microcap Explosions. This is Mariusz Konieczny, and today I am interviewing Jerry Flum, the CEO of Credit Risk Monitor. Jerry, thank you so much for joining me.
A pleasure, Marius.
Jerry, we had a few conversations about the company. I introduced the company to my listeners through a write-up, and I wanted to do this interview because people like to hear from the CEO explaining the company, the trends, and all the things that people are looking for. So maybe Jerry, can you take a few minutes and just describe the company to maybe someone who never heard about
Okay.
this before?
The best way, Marius, for me to describe our company is to relate it to something that most people are familiar with. We are very much akin to what Dun and Bradstreet does. What we do is we analyze corporate credit analysis. In other words, we look at the ability of companies or corporations around the world to satisfy their customers that they're selling to, or companies they will be looking at purchasing at companies they purchase from, whether that company is a good credit risk. In other words, I want you to think about it in a way that when somebody goes into a store and purchases a piano, you are not going to walk out of that store unless you pay the store either cash, a check, a credit card, or some kind of an agreement that you're going to be able to walk out with the piano. However, in a business-to-business transaction, it's very, very different. There, Company A makes 500,000 widgets and sells it to Company B. The widgets leave Company A's factory, and then Company B sends out a billing saying you owe us, let's in this case, $3 million. And they may put terms on it. They'll say you need to pay us this $3 million, 210 net 30 or 210 net 90. And what that means is that if you pay within 10 days, then you'll get a 2% discount off the bill, but you need to pay in 30, 60, or 90 days. And so this is an extension of credit that happens in probably the 99% of all business-to-business transactions. There's an extension of trade credit. And this trade credit is enormously big. It's much bigger than most people really assume, even though we live in a consumer market or a GDP that's influenced by consumers. For the most part, before you get to a consumer expenditure, there can be many, many business-to-business transactions that go into building the product that the consumer buys or even the service that the consumer buys. As an example, to make a car which may sell at $30,000 or $40,000, there could be multiple business-to-business transactions between the manufacturer of the automobile and the suppliers. People sending steel, people sending copper, people sending glass, or corporations, I should say, not people. And so all of these things are an extension of this trade credit. And it's very, very critical to the seller to know that they're going to get paid, because the working capital of their company requires that they get paid before they can make anything else to sell. They also are worried about not only will they get paid or not get paid, they got to worry about how quickly they'll get paid. In other words, they need to be able to count on those dollars that they build out in their bill coming back to them so they can make their next product. In other words, how do you make, if let's assume you're making shirts and you sell 30,000 shirts to Walmart, you need to make sure Walmart pays you in a timely manner, because you may get an order in from treasury stores for another 20,000 shirts. How are you going to make it? That's the capital that comes back, is the working capital. And so we're very, very important in that area of the world. We differ from D&B in that we specialize in about 57,000 public companies all over the world. In other words, our analysis is of these public companies all over the world. And so we specialize there, and we have a score called the Frisk score, which is 96% predictive in predicting whether bankruptcy will occur in that public company over the next 12 months. And we run that score every single night, so it's really up to date. We also follow smaller companies or private companies, but not to the extent that Dun & Bradstreet does. We have a PACE score, which is about 70 to 80% predictive. And there we follow probably 100,000 of the larger private companies all over the world. And we have data on another 3 or 4 million private companies around the world. But the specialty that we really are involved in is this public company and 100,000 of the private companies with our scores. The Frisk score, which I've indicated is so powerfully predictive and so up to date, is basically run on 3 or 4 major ingredients. The first thing that we are putting into this score, as I said, which is 96% predictive of bankruptcy, is that we're looking at the stock price volatility. In other words, we're looking at how the price of the stock is moving up and down, and then we make some adjustments for dividends and so forth, and we're running that every night. Number 2 is we run a select group of ratios which deal with cash flow. Basically, many of them, some derivation of the Altman score, the Altman Z-score, but we weight it very differently, and we run that. But that data only comes into us because, remember, when we're looking at public companies, the most important thing that we're looking at is their financials. They have certified financials, which come out roughly about every 90 days. In some foreign countries, they may come out every 6 months, but in the U.S. or North America, it's mainly every 3 months. So we're looking at these ratios. We weight those into it. The third thing that we weight into it is we weight into it some of the credit rating agencies. We get credit ratings from Moody's, and we get credit ratings from Fitch, and we get some from D&B, Morningstar. And so we are looking at those ratings also, and we put that into the score. And lastly, we are looking at something called the click scores. In other words, we have a really large base of large corporations all over the world who use our service. And what happens is they come in and they pick whatever companies. We have unlimited usage for them. And they put in whatever companies they want us to look at the risk of bankruptcy. And then we also are monitoring those companies all the time to make sure that everything is going on. And if there's any kind of a change in it, we send out emails. What we found is when our Frisk score gets to be really bad, when it gets to be 5 under, 1 being the lowest is the most risky. When it starts to get into the 5 and 4 and 3 and obviously in 2 and 1 category, what happens then is our subscriber base of users starts to click on these companies that they're concerned with, and we can begin to see their concern beginning to build, and we run that score every night. So what happens is we can see when the supplier base to a company is getting very concerned whether, in fact, that company can pay its bills. The difficulty that happens is if our user base, our subscribers, start to feel uncomfortable about a company, they can make some reactions to it. They can cut back the amount of trade credit that they're extending to that company. And that creates a real problem for that company because they need to pick up an alternative way of getting capital into their company because they're not going to be getting this extension of credit by their suppliers. And to put this in some kind of perspective for you, how important is this trade credit? Trade credit is 15 times larger than the commercial paper market that these companies are using, public companies are using. In fact, 1/4 of all corporate credit for public companies is trade credit. And so it's 3 times larger than bank loans. So when our subscriber base is starting to get concerned about a company because our scores are bad, it's a serious enough problem for that company that they need to be able to react to it. I hope that kind of gives you a little bit of a background on what we do.
Yeah, that's very, very nice. Perfect. When your clients want to learn about the counterparty risk, that's when they
Hmm.
come to you and then they subscribe to your services. Is this
Yes.
something that they do? They subscribe to it for like a 12-month basis on a recurring base? How does it work?
We sell basically a yearly, 1 year subscription, and we have a very, very high re-sign rate. We're a very stable company. In fact, our re-sign rate I'm not going to disclose it, but it's very, very high. In other words, when they start to use our service, they become long-term users of our service. And why is that important? Because when you're looking at a company, you want to make sure that they're extraordinarily stable. Most companies have to go out every year and reinvent themselves, so to speak. If you're selling cars or you're selling shirts, comes January, you need to start selling the same amount. If you did, 50 million last year, you got to resell that 50 million and whatever more you can sell in the next year. In our business, such a really high percentage of our business comes in because it's a recurring stream of income. What makes our company exciting for me, actually, in running a small company, is that I want to know that it's very stable. And what we do in our company to ensure that is, one, as I said to you, we are recurring streams of income with a subscription model, which is very hard to get off the ground. And I'll explain that in a second. Number two is we have a super strong balance sheet. We have roughly about close to 10 million plus in cash, and we have debt, which is a PPP loan of roughly 1.5 million. So we really have, net of any debt whatsoever, roughly about $9 million in cash, and no debt except for that small PPP loan. And so we have a very super strong balance sheet, which is critical to the stability of a company. Then the third thing that's important about our company is that our service is somewhat countercyclical. In other words, companies buy our service or subscribe to our service with greater and greater frequency when the economic environment gets to be scary, because they need to make sure that the customers they're selling to or the suppliers that they are buying from, they need to make sure that those companies are not in trouble when things get bad. So we're countercyclical. We have a super strong balance sheet. We have a reoccurring stream of income. And in my mind, that's what makes us as a small company one of those rare birds that has great stability and continues to grow and grow and grow. Right now, the major part of our market is, or has been historically, the credit function at most corporations around the world. And it's only been in the last 3 or 4 or 5 years where now, all of a sudden, the purchasing departments, in other words, the selling part of the company is looking and checking on their customers to make sure they're in good financial shape and they're going to pay their bills. And they look at X amount of companies, and those are customers. Another part of their company buys their service from our company, but they're looking at a different set of corporations. They're looking at the companies that supply them. That's a supplier base. So we're starting to broaden out our penetration into these customers that we sell. And to give you some idea of how large we are now in terms of customer base, we have roughly a shade under between 35 and 40% of the Fortune 1000, and well over 1,000 other large corporations all over the world who are part of our subscriber base.
Okay, and when a particular client signs up for your services, is do they all pay the exact same price, or are there different packages that you offer to them?
Well, first of all, one of the wonderful things about our business is we get paid for the most part up front. In other words, we take the cash in. We don't put it into our P&L. We bring it in monthly, but we get the cash payment up front, so we don't have a receiver problem. But as reacting to your question, uh, our service has some very basics to it. We sell a service that relates only to companies who want a North American service, have unlimited usage North American. We sell that without going into pricing exactly, at a reasonably good price, but we have a higher price service when they want coverage for all over the world. The reason why the pricing is somewhat different is many different customers come in, and after they buy our service, they buy seats or they buy passwords. And so they could buy, if they're North American, they may want to buy the North American service, and they may want 5 passwords. And each one of the passwords is more money over that yearly subscription, or they may buy a worldwide contract. And when they buy a worldwide contract from us, there they may want many more seats again, more passwords, and again they pay more for that. So the pricing there.
Passwords, you mean like passwords for individual people within their company?
Yes,
Okay.
yes. We also now, more and more in the last year now, what else is coming in? Companies are coming in and buying something called an enterprise contract, where they say, look, we want a whole bunch of passwords, and we want special kind of pricing so we can have our guys, a lot of guys in our company look at it. And some of them now are buying something called an API. An API comes in where they come. We have very detailed financials. If somebody goes up on our site, what your subscribers should do is go up on our site, creditriskmonitor.com, and you'll see a couple of sample reports. It's very, very detailed. In other words, when these people look at a company they're concerned with, they can peel down depending on how much concern they have. There's all kinds of ratio analysis, yearly, quarter to quarter, sequential quarters, all kinds of spreads, all kinds of data on whether they're paying their bills or not and what have you. So what happens is they're clicking all over our site, and that's, by the way, the reason why we are able to crowdsource them when they're getting concerned. But they buy lots of different styles of our company. They, as I was saying, they buy an API where sometimes they will come into us now and they'll say, look, we don't want all of the data that's on your site. We want to have a certain amount of people in our company who have access to everything on your site, but we also want very specific data points off of your site that we can bring on into our own company's usage all through our company, and that's an API feed. And so now we are starting to get into these larger API feeds. This whole business is in transition for us. So many large companies now are beginning to realize, like, holy cow, you need to know what your customers are looking like for financial risk, and you need to know what your suppliers are. And so they're starting to use our data through many different parts of their company, because we are 96% predictive on public companies and 70 to 80% on the privates that we're handling. So, they want access to our data.
Interesting. And you mentioned your competitor, Dun and Bradstreet. They are,
Yes,
I mean, they are a huge company, over
huge company.
$10 billion market cap, and here you are, this tiny company in relation to them, but somehow you broke into that market, which is not easy. Can you talk a little bit about that?
Well, I think that what happened to Dun & Bradstreet, and I want to preface this, Dun & Bradstreet is a really terrific company, and the people in the company are smart, and this is a really first-rate competitor. However, Dun & Bradstreet's been in business for roughly, I don't know, probably 150 years. President Lincoln worked for Dun & Bradstreet. President Grant worked for. These guys have been around a long time, analyzing risk at companies. And when you get into a position where they had roughly 80 or 90% of the market, what happens to you over time is you get into a monopoly position. And monopolies are fabulous things to have. Everybody would love to have a monopoly. But one of the advantages of a monopoly is people need your product irrespective of the price. So over time, the utility of the service gets away from the price. So the Dun& Bradstreet guys had, 80 or 90% of the market when we came into the market. But they were, for the most part, really overpriced and specializing on coverage for all these millions of private companies around the world. We came in and we priced our service 80 or 90% below them, and we only concentrated on public companies. So what happened is we were able to get a foothold because we were giving an all-you-can-eat contract, in which we still at this point do. We give all-you-can-eat contracts. And so what happened is we got tested by companies would come in and say, hey, we'd like to test you because you guys are, if you're really as good as we hope you will be and your pricing is, let's see how good you are, and maybe what we can do is get a discount on our price from D&B. And that's basically what happened to us. In other words, when we came in, we went up against D&B. We didn't have to force them out of the contract. In other words, D&B, we share customers with Dean, and probably 80 or 90% of our customers we're sharing with Dun & Bradstreet now. They use us for the public company coverage, because we're so good, and they use us on lots and lots of the private companies, which we now follow, which our service is extraordinarily good, and they probably are able, not probably, they were able to get Dun & Bradstreet to discount some of their service pricing so that they could use our service, because Dun & Bradstreet many years ago charged on a usage basis. So they would come in and use our product, which was so good on the stuff that we followed, and they could negotiate some discounting from Dun & Bradstreet. That allowed us to get into the market. Then once we got into the market, they began to realize, God, this stuff that Credit Responder has is really great stuff, and very up to date, very, very, very good information, and very predictive. And that's what got us into the market and allowed us to get a foothold and grow our company.
How do you grow your revenues? Do you grow them by signing up new customers, or do you try to upsell the current ones? How does it happen?
It's a combination. We have a whole team of people who sell into getting new customers, whether they be in the credit function of a corporation or the purchasing department of a corporation. But then we have another whole group of people in our company, which are account management. And the account management, every one of our subscribers, every one of the companies becomes a subscriber to Credit Responder, gets their own account executive in our company, whose job it is to make sure they learn how to use the service correctly, that they are using it. In fact, we encourage them to increase their usage and put in more and more companies for us to cover. And we are a all-you-can-eat contract. So what happens is, we have an open dialogue because we're not trying to get more money out of them by putting more and more companies into coverage. What then happens is that when they start to use us, they start to get by more and more passwords. Because remember, our information is extraordinarily detailed and gets deeply into these companies. So they can have, X amount of credit managers who are looking at thousands of the customers, and it's way too much work to have one or two credit managers looking at several thousand customers. It's just too much work. So what will happen is they'll have more and more credit managers, and they'll say, hey, look, we want this guy to have a password, we want this credit manager, or we want this purchasing manager. So we're upselling. Second place we upsold was when we started the business, we only followed North American companies, and we came out with a worldwide service, and we began to upsell them from North American coverage to worldwide coverage. And as I said to you before, we started out in the credit department, department of these corporations, and now our teams have begun to upsell into the purchasing departments of corporations, which are much bigger contracts than even the credit parts of the corporation. And in fact, I would say the quickest part of our growth now is, strange as it may seem, is the purchasing side of corporations, where people need to be really concerned with the supplier. If the supplier is getting into economic risk, a couple of things begin to happen. If they go out of business, they could be making critical parts, in which case your whole, a factory could come to an end. They don't have ignition parts for a car. They have every other part, but not enough ignition parts. That factory stops. So the purchasing risk for a company going out of business is, on the purchasing side, having a supplier get into problem is a real risk. But number 2 and 3 is, if you're a supplier and you're getting into economic difficulty, you're not going to be able to spend as much money on R&D to find new products and better products for your customers, or even quality control. These are things that you will start to cut back as you try to survive your company. And so looking at the economic health of a supplier is really critical stuff. It's not just the environmental risk at that supplier or the labor risk. It's the financial risk, which impacts that supplier's ability to provide an ongoing product or to supply a product that is continually being improved by quality control and R&D. As I said before, on the credit side, we're upselling because they have different parts of our service that they're buying, whether it be North American and they're streaming to worldwide, or they're bringing in many more credit managers. And also, we're finding where, CFOs want to put in all their competitors. Would want to see, they want to know what's going on with their competitors. And I'm telling you, we just have really great up-to-the-minute information that is pushed out every single day and night. Any kind of change we send out to these corporations in emails and all kinds of things, so they're really up-to-date. We replace quite a bit of the hard, difficult, day-to-day grunt stuff that you got to get done with really high-quality data.
When I first wrote up Credit Risk Monitor, and the first time we had a conversation, I looked at your company's revenues over the last 10 years, and I looked at the growth rate, and then I thought COVID, and I immediately jumped into the conclusion that a Credit Risk Monitor is going to be good during this time of COVID because of the fear and all that. And you said to me, yes, COVID might benefit us, but there is a much bigger picture. Don't just look at COVID. Can you just kind of bring my listeners to understand this?
Look, I, in a different life before I took over this company, ran an investment firm and a hedge fund. And one of the things, and we invested in small companies, and when you do that, you start to, or I did anyway, I looked back and I needed to find out what are the risks in companies. And one of the things that comes startling out to mind is debt. In other words, one of the things that changes the viability of corporations, makes them risky, is the amount of debt that they start to bring in to the company. And on our site, we have free charts that people should take a look at. And what they will see is that debt, as a percentage of the gross national product of the United States, or mostly every country in the world, is now at world record levels that have never been seen before. So the debt levels at corporations all over the world have picked up dramatically. And it's like a time bomb waiting to go off. How high can it go? Right now, it's higher, and I want to make sure we all understand that, higher than it has ever been. It's higher than 2008, 2009, 2010, when the whole world almost collapsed into a depression. And so that risk out there is a real ongoing risk, and it just needs something to trigger this internal collapse. Now, recognizing that, the governments of the world have gone out and lowered interest rates to artificial levels that have never been seen before. As an example, we have $15 trillion of negative interest rate debt out there. And you got to wrap your head around what that means. Negative interest rates mean that basically a lender is going to a borrower and saying to that borrower, I will give you $1, and all you need to do is give me back 95 cents. Maris, that has never happened in all of recorded history. Now, there's a reason for that. The reason for it is some of these lenders, they're lending to governments. In other words, when they lent this $15 trillion to the governments of France and Germany and Belgium, Japan, it's all over the world, because these governments, the lenders of the world, are so frightened to death that they want to lend to entities that have no risk of going out of business. In other words, all they want is they want to make sure they're going to get their money back, even though they're going to get a little bit less. What they're betting on is that we're talking about a very strong economic contraction is out in front of us. And they want to make sure that they get that 95 cents on the dollar that they get back. If they give it to a corporation or they give it to a mortgage holder, they could lose a fairly good proportion of their money. Now, that argument of lending to this government to get to 95 cents is basically the following argument. It says that 95 cents in 5 years will buy for me $1.20 or $1.30 of goods and services. In other words, I'm looking at it not at the interest rate I'm getting paid, but what I will be able to buy with the money, which I know I will get back no matter what, because it's the government of France or Germany. They have an army, they have a navy, they have a Marine Corps. They're not going out of business. And we have charts on this all through on our service that people should look at, where you can see this enormous buildup. That's the major risk in front of us, and that's why our service is so critical to everybody all over the world. Our service for corporations looking at each other is critical, and for their suppliers. And so that's the major story. The virus is, look, an important thing, and you're right, our business is starting to, people are now beginning to realize, my God, this is a huge problem, so our business, yes, gets stronger. But that's that's a pinprick. That's what causes this economic crisis in front of us. There's just no way out of it. The debt levels are just too high.
Okay, thank you very much for this. Obviously, investors who are interested in buying a stock of a company, at the end of the day, they want to make money. So a lot of times they want to know, like, what is the end game for credit risk monitor? Is it to eventually maybe list on Nasdaq, sell to someone, or just continue to grow and stay independent?
Well, personally, look, if some company came in and offered a price that was outrageous, would we sell it? Sure. I mean, one can never discount them. But to be honest with you, Jerry Flum, like I said, I ran a hedge fund. A hedge fund is the major owner of Credit Risk Monitor. What would I buy? I mean, when I look at it, where do you redeploy assets? I got to tell you, I want to be in countercyclical, strong balance sheet companies with reoccurring income streams. So, Credit Risk Monitor is, just the perfect place to be. And so that's one of the things that, we have to deal with. Yes, we are, as we get larger, we will list on other exchanges if that's an appropriate thing to do. Yes, if somebody came in and offered a pretty outrageous price, yes, we would have to consider a sale. But personally, if we just continue to grow our company, look, there's something called enterprise value of companies, and basically The enterprise value of credit risk monitor is the amount of shares, which there's roughly 10 million and change. The price of the stock is roughly, I don't know, 2.25, and or some number like that. So roughly the market cap of our company is 25 million dollars. We have excess cash and no debt. If you take out all the, like I said, we have this one small debt instrument, this PPP loan, and it's roughly $1.5 million PPP loan, but we have roughly about $10.5 million worth of cash. So the cash in excess of any debt is $9 million. So in enterprise value, you take the market cap minus the cash at $9 million, and you got $16 million, which is approximately roughly in the area where our revenue will be this coming year. So we're selling at 1 times enterprise value. Listen, if you can find other companies in the world that are selling at that low price, then you should buy them.
Yeah. Well, I think that the problem that people have, hedge funds, is they're having a hard time getting shares. The liquidity is low.
Yes.
And I think that as your company, let's say 5-10 years down the road, as your revenues grow, because looking back, they are constantly growing. It's a matter of the rate. So
Yes.
if your company becomes revenues of 30 or 45 million or 50 million dollars per year, then I think your liquidity on its own will increase, and that could be a driver in the valuation on its own.
Well, look, I spent a huge part of my career running a hedge fund and was in the institutional side of the business of the investment world, ran the research department. Look, at the end of the day, as the price of the stock goes up, what does a professional investor want? He's not looking at how many shares he can buy. What he's looking at is how much of his capital can he invest. In other words, if there were only 500,000 shares or 1 million shares of stock in our company instead of 10 million, but each share was selling for $1 million, then large, firms would come in and buy, 100 shares or 1,000 shares or 10,000. It's the market cap, which is what professional investors are looking at. How much money can I invest, not how many shares? So when you look back at any of the really great growth companies in the last 50 or 30 or 40 years, when they start out, even before they become public, people own pieces of the business, and they are selling them back and forth to each other, within the family or within a town where a company started, and people put a little money into this private company. And so shares start to trade, and then they finally go public, and there's a few shares. And so they start small, like Microsoft. Every one of these companies that are huge today started out as very, very small companies, which you had a hell of a time buying shares. But you only wish that you had been able to buy, 1,000 shares of Microsoft or 10,000 shares of Microsoft when it was a tiny little company. Every large company today, for the most part, starts out as a smaller company. And so I never really look at that. Look, there is no doubt in my mind, having done this for the hedge fund, we bought small companies, and we bought them and we held them forever. And we got there early, and we wanted to make sure it was a good, we followed them closely. But my point is, you want to be able to have stable, growing companies that have a really reason to be. And you want to have a management team that is devoted to building the company and is going to stay involved in doing that. It's not promoting its stock. We're not out promoting our stock. We don't have IR counsel. If we're spending money in our company, we're spending it on building the company, training more people, buying more content. That's what we do. And so you need to slowly accumulate. We had one hedge fund was able to accumulate 700,000 shares, and I take my hat off to that guy. He's a very, very, very smart fund manager, very young, aggressive fund manager. He took his time, energy to build a position. And quite truthfully, I never knew he was doing it until he finally, he had a filings. And when you get over 5% of a company, you got to file.
Now,
So he
okay,
showed up.
thank you for that. The final question that I have for you is, um, you, your company is growing and it will continue to grow. How one factor that's important for companies like this to be successful is actually the growth runway. Like how can you just give us a sense of the size of this market?
Well, we are in the trade credit market. In other words, we're looking at corporate trade credit, the extension of corporate trade credit. Let me give you an idea how big this is. It's 15 times larger than the commercial paper market. In other words, when you look at corporations, the extension of trade credit, which we're analyzing, is the trade credit is 15 times larger than the commercial paper market. 1/4 of all corporate credit or liabilities or borrowings is trade receivables. It's 3 times larger than all the bank loans to corporations. It's trillions of dollars. This is a huge market, and companies are going to, as they grow, going to have to be analyzing this extension of their trade, and that's what we do. And I'm telling you, you can look at our subscriber base. It's our subscriber base now. Not gonna be. This is not where I'm. This is where we want to get to. I'm telling you, this is a done deal. We have between 35 and 40% of the Fortune 1000 as part of our subscriber base today, plus well over 1,000 other large corporations around the world. We're not a startup. There's a huge market out there. This is a big, big market. There's a huge need for sophisticated corporate credit analysis. In fact, if you look at it, the corporate credit market right now is the non-financial corporate debt out there is probably 50% of the gross national product of the United States.
Wow.
That's huge.
Wow.
And so this is a major league market, and it depends on how creative and how we slice and dice it. We have a fabulous team now inside the company. The question, it's our company will grow as well as we execute. Our job is to find really good people and continue to find great content and continue to put all this stuff together. And look, like I said to you before, we have a huge corporate base of clients already. Our execution has been, it's not shabby.
Yeah, yeah.
It's not, something different. If you and I were talking on the phone and I said, look, this is where we want to go. We'd like to get, we'd like to break into the large corporations of the world. We'd like to do this. Look, yes, we want to go further and further and do more and more of that. But we all have to understand, we have done that. We have broken into the large corporate marketplace all over the world. We're selling companies in probably every continent in the world, and we're analyzing companies on every continent of the world. If you go up on our site, you'll see a listing of all the corporations in every single country of the world that we're following, and you'll see it's all over the world.
Yeah. Okay, Jerry. Well, thank you very much for this interview. I'm very excited personally to be a shareholder of Credit Risk Monitor, and will continue to be because I see a bright future. And so I really appreciate you taking the time to do this with me, and I hope we can do it again in the future.
Listen, I want to say something. I appreciate having a conversation with you and our company, and you spent the energy and time to find us in the end. So God bless. You did a great job. You deserve the credit for it.
Thank you.